go to the next paper, which is the title of the paper is a macroprudential reaction function emerging, and is it sensible? And the presenter is David Aikman from King's College London. And David, you've been waiting a long time. Thank you. And please go ahead. Can you share your slide?
Frank, let's see if I can share my slides. Is that okay? Can you see them fine?
Just fine.
Perfect. Okay. So, a big thank you, Frank, for the introduction, and to the organizers for including the paper on the program, and for this really nice session. I've really learned a lot from the previous papers. I think they were all very interesting. So this is a joint paper with some of my ex-colleagues from the Bank of England, where I used to work until recently. So John Bridges, Anil, Kashyap, and Caspar, Siegert. Given the connections with the bank, I'm kind of obliged to start with the usual disclaimer that these shouldn't be taken to represent the views of the Bank of England. Okay, so this is a paper about the conduct of macroprudential policies in the decade or so following the last crisis, the global financial crisis. And this is going to be a pre-COVID analysis. So the time window is going to run up to the end of 2019, just before everything in the world, as we know it, changed. And this is a period where a lot of the countries we're going to be looking at in the cross-country analysis we're going to look at, these countries were either recovering from post-crisis troughs, or they were in the kind of upswing of a financial cycle. So this is an episode where macroprudential policies were kind of either being activated for the first time or being tightened. Now, there's been a number of efforts in recent years to compile data sets of macroprudential actions. And there's a particularly nice one by the IMF that's, I'm sure many of you will have seen. What strikes you, though, if you open those databases, you're confronted with like a lot of complexity, and there's a high dimensionality to the way instruments are characterized. So the IMF's database, for instance, classifies, I believe it's 17 distinct macroprudential instruments that are being used. And that kind of makes it hard to kind of draw general lessons, in my view. We're going to try and kind of cut through some of that complexity and kind of reduce the dimensionality in this paper. And what's going to allow us to do that is, firstly, we're going to focus on a panel of advanced economies. So we're going to look at 15 advanced economies. And why that's useful is because issues relating to capital flows, capital control type measures are kind of less relevant for this group of countries we're going to look at. So that allows us to discard many of the things that are classified as macroprudential in the IMF's database. And secondly, we're going to focus on cyclical macroprudential policies. So what I mean by that is policies where the calibration of the tools is kind of routinely discussed. And you might expect the calibration to be adjusted depending on the state of the financial system. So let's contrast that with more structural tools that are set on a one-off basis and kind of left unchanged. Now, we argue in the paper that you can really boil down the kind of instrument set to two areas if you're willing to make those assumptions. So one area is the set of policies that are used to influence banks' capital buffers, where I would say the countercyclical buffer and related tools is the kind of prime example. And the other area is policies that are really trying to limit the degree to which mortgage debt runs up in the financial cycle. So tools like loan to value and loan to income restrictions. The two plots on the charts here show the evolution and the kind of usage of these tools over the decade or so that we're going to focus in on. So on the left, you can see CCYB, or countercyclical capital buffer actions have been taken by kind of a growing number of countries as as the last decade progressed, with particularly from around 2018 onwards, there was quite a noticeable pickup in countries applying this tool. The chart on the right shows you usages of macroprudential mortgage debt limits, loan to value, loan to income restrictions. This is a count of the number of cases of usages or changes in the calibration of these cases. And across the 15 countries in our sample, it turns out that around 2/3 of the countries have applied either one of these two tools. Now, the kind of central question we're going to ask in this paper is whether there's evidence of countries applying these tools in a systematic way. So we like to think of monetary policy as following something like a Taylor rule. I mean, it's not exactly that, but that's the kind of approach at least. And the question is there a similar reaction function emerging in the usage of macroprudential policies? We think that's an interesting question for two reasons. So firstly, it seems likely to us that a good part of the transmission mechanism of macroprudential policy is likely to operate through expectations, just like it does for monetary policy. And I think a necessary precondition, if that's going to be the case, is that there is this kind of predictable element to the way policies are set. The second reason, I think, is as we emerge from the COVID crisis and countries begin to think about reapplying some of the buffers that were cut when that crisis struck just over a year ago, it's kind of useful to have a benchmark of, what does the average experience look like in terms of applying these tools last time round. So that's a couple of reasons why we think it's an interesting question. The way we're going to tackle this is by running some simple Probit type regressions. So we're going to model the probability that housing tools, so LTVs, LTIs, and related tools, H, are either activated or tightened as a function of a range of macroprudential indicators. And we're going to use annual data for this exercise. So the question is, what's the probability of macroprudential policy being tightened in 1 year, conditional on information about the risk level the previous year? Do the same thing for the countercyclical capital buffer. That's the second equation. And then the third one is, as a benchmark, we also estimate just a linear regression model for the countercyclical buffer, given it has a cardinal scale in the way that housing policies do not. We start with the simplest case of univariate regression, so where we apply macroprudential indicators one by one to see if they help explain these policy actions. And the chart here shows you the results for, firstly, the housing policy Probit reaction function. We find evidence that these housing policies seem to be responsive to measures of credit growth. So when credit growth picks up in the economy, increases, the probability of a hike in housing macroprudential policies goes up. The effect is economically significant, so we get something like a rough doubling of the probability of a hike following a 1 standard deviation increase in credit growth. I think against our prior, and surprisingly, we don't find evidence that these policies are reactive to debt service ratios. It's a point I'll come back onto later. Also, they don't seem to respond to house prices. So it seems to be credit growth, which is the driver of these housing policies in our sample. The next parts of the table focus on countercyclical capital buffer actions. Here again, we find evidence that credit growth is a significant driver of these CCYB, countercyclical capital buffer actions. This time, particularly household credit growth seems to matter. And we also find evidence that this time house prices are a driver of these CCYB actions, as is volatility. So we've inverted a measure of financial market volatility here, and it turns out to be the case that when this volatility measure is low in the economy, when markets are very calm, that's the type of environment where macroprudential authorities are hiking the CCYB. All right, so that's the first question. And then the second question we're going to look at through a few different lenses is whether the reaction function that seems to be emerging, is it sensible or not? Can we kind of rationalize it? And ideally, what we'd need to answer this question, of course, is some kind of structural model linking the resilience of the financial system to tail risk at the macro level. And I think we're kind of not there. We don't have such a model that we can use to explore, use it as a laboratory to explore different policy rules. So in the absence of this, we're going to lean on the recent GDP at risk literature. So this literature, if you're kind of not close to this, essentially uses quantile regressions to try to model the full distribution of GDP growth as a function of different macroprudential indicators. And we're going to focus on the information that's contained in macroprudential indicators today for GDP, for the left-hand tail of GDP growth 3 years hence. So it's enough time that you can actually take action if you're a macroprudential body and you saw this kind of macro risk building up. And our prior really is that there should be some correspondence, I think, between indicators that weights heavily in terms of explaining macro risk in our GDP at risk regressions and the indicators that macroprudential authorities seem to be paying attention to and responding to when they're setting their tools. The purple row at the bottom here kind of performs that exercise. So these are the GDP at risk weights that emerge from those quantile regressions. And it turns out, I think this is unsurprising, that indicators of credit growth and house price growth are good predictors of tail risk at the macro level 3 years hence. So it's kind of sensible that these are variables that are also feeding into macroprudential reaction functions. What's a bit more puzzling, though, is that household debt service burdens seem to matter a lot for macro risk, but they don't seem to be, variables that are entering the reaction functions. Neither is the current account deficits. And our measure of financial market volatility, that matters a lot for GDP at risk in the near term. So if volatility spikes upwards, that means you have a lot more risk over the next year. But if you have a 3-year ahead horizon, it turns out that our volatility measure doesn't predict 3 years ahead macro risk. So there's a bit of a puzzle as to why macroprudential authorities seem to be paying attention to that in their policy actions. Okay, so we're now going to move to more of a multivariate setting. So I think an obvious critique of what I've showed you so far is that macroprudential authorities obviously look at a wide range of indicators when they're deciding on their choice of tools. They're not just looking at one indicator. So it makes sense to try and incorporate information from lots of variables. The challenge for that, for us, to be frank, is we have a small data set. So there's 15 countries. We've got about a decade's worth of data. So it's not a large data set. So we'd be running into degrees of freedom constraints quite quickly. So what we try and do to start with is we try to produce an index of aggregate risk, weighting together information from different indicators. And we focus on the indicators that seem to be entering the macroprudential reaction functions I showed you earlier. So measures of household and corporate credit growth, house prices, and financial market volatility. And as weights for this index, we're going to use their GDP at risk estimated coefficients. This chart shows you, almost as a sense check, if you like, the index of macro risk. I'm going to call this GDP at risk from now on, that emerges from this exercise. So think of 0 on this chart as being like a normal level of GDP at risk. This is the level you'd obtain if all of the right-hand side variables were at their historical means. And then a number above zero, a positive number, is kind of a fatter tail than normal, if you like, of the macro risk distribution. And this, I think, tells a reasonably intuitive story that this is on average across the 15 countries in our panel. Macro risks were increasing in the run-up to the last crisis. They then kind of subsided and remained quite subdued for a number of years in the post-crisis period before there's some evidence of a return to normalcy at the end. And this chart just plots gives you a sense of the degree of variation, individual country variation around that average level of risk. So what we do next is we ask, what about for the countries that have activated these tools? What did the macro risk picture look like for them? And that's what you can see on this chart. So the red line is for the countries that have activated macroprudential policies. That's the level of macro risk they faced, versus green are the kind of non-activating countries. And the kind of bottom line looks to me to be that, particularly towards the end of the sample here, the countries that have activated the tools were facing a higher kind of background macro risk level. I should have said, sorry, just to clarify, that was for the counter-cyclical capital buffer. And we can do the same exercise for the housing tools, and we get a similar picture. Countries that have activated mortgage debt limits have typically had a higher level of background macro risk, although there's some evidence of those lines coming together at the end. I can show you that information in a slightly different way as well. So we can plot, this time this chart plots the unconditional distribution of GDP at risk across the period. You can see it's skewed to the left, so that reflects the idea that a lot of countries were recovering from the post-crisis, from the financial crisis for a lot of this period. So risks were generally subdued. The lighter bars here, now I'm going to layer on the case where these are just the observations of GDP at risk that preceded a tightening of either the CCYB or mortgage debt limits. And you can see this time it's kind of clearly skewed to the right, indicating that it appears like countries were reacting to a higher risk level when applying these tools. Just as a very quick exercise, this chart, we were kind of one of the authoring team was very interested in who the outliers are here, because we initially wrote this paper before COVID, so we were interested in which countries have kind of are lagging behind where they should be given the kind of average experience across countries, and which countries are kind of racing ahead. And our analysis at the time suggested that the US, Germany, and France had in place lower CCYB rates than one might expect, given the regression line. The Nordic countries pretty much were all kind of above where you'd expect them to be, based on this analysis. All right, the last thing I'm going to show you is this time returning to the probit reaction functions I showed you to start with, but this time I'll add in some additional indicators in a multivariate setting to show you, and I'll make 2 points on the back of this. So the first point I'd like to make is if you add in those 4 indicators, so household corporate credit growth, house prices, and financial market volatility into these reaction functions, one thing that happens is you can explain a lot more of the variation in the counter-cyclical buffer actions than you can with single indicators. And that's not terribly surprising. So we can get up to something like explaining around 30% of the variation in the CCYB with just these indicators. That doesn't happen for the housing tools, which kind of for us is quite an interesting finding. So the housing tools remain much harder to explain with these indicators. And for us, that was evidence that either these tools are kind of set in a more structural way that they're not so responsive to the financial cycle, or that there's just more idiosyncratic country-specific effects going on that affect whether countries feel the need to apply these tools or not, maybe related to the degree of mortgage insurance, public mortgage insurance, and so on. The second point I'd like to make is if you were willing to accept that the GDP at risk regression gave you a sense of how you should weight these variables, we could compare the risks that emerge from a reaction function estimates to those GDP at risk weights and see, are there some indicators that are being overweighted and others that are underweighted? And it turns out from this that, particularly for the countercyclical buffer, I'd say corporate credit growth has a lot smaller weight in the reaction function estimates than would be warranted if you believed our GDP at risk regressions. And equally, volatility has a much higher weight in the reaction function. So that's, let me conclude there. I'll just briefly summarize the points. So we find evidence that the countercyclical buffer and housing tools are responsive to indicators of credit growth in the economy. The countercyclical buffer also seems to respond to house prices and to financial market volatility. We find some evidence that these tools have been activated or tightened in countries where macro risk is higher. And we can explain around 30% of the variation in the CCYB through quite a small set of indicators. I'd say the puzzles that emerge from this are that there seems to be no role for debt service burdens in driving CCYB actions or mortgage debt limit actions, even though that as an indicator seems to be, it weights very heavily in a GDP at risk setting. I would say another possible puzzle relates to our limited ability to explain housing policy actions, and where it just seems like there's a lot more idiosyncratic factors entering those decisions to activate those tools. And then lastly, it seems like salient indicators around house prices or household credits play quite a large role in CCYB actions, and corporate credit, by contrast, plays a negligible role, which is an interesting thing, I think, given that towards the end of this sample period, a lot of countries were experiencing corporate credit booms, so suggesting we may have had, we should have had tighter policy, perhaps. Let me stop there.
Thanks, David, for that very interesting, clear presentation. Fascinating study. Now, we have Linda Goldberg of the Federal Reserve Bank of New York to discuss your paper. We're very fortunate. Linda, I've had some instability with my video, so I asked Chule Tan of the team to share your slides. So she'll be, the team, the ABFER team is going to be managing your slides.
So thank you so much for inviting me to discuss this paper. The disclaimer applies. These are my views, not the New York Fed or the Federal Reserve System. So let's change slides. Okay, so David, I really enjoyed reading this paper. Let me give a quick what my read is. Is a macroprudential reaction function emerging? So the way that the paper proceeds is that if a reaction function exists, it's most likely observable if you take a look at the countercyclical capital buffer or housing, household debt tools. So the authors, to kind of hone in on this, choose advanced economies with relatively similar institutional frameworks and look at the relationship between tool use and financial risk indicators. Then they do a range of empirical tests over data for 15 advanced economies, and find really that if a reaction function is emerging, it's not strong or systematic, and possibly not sensible, although they don't say it that way, and that tool use is very uneven, that only 9 of these countries used the CCYB, and only 10 used some form of the housing tool through 2019. So let's go to the next slide. So my blunt reaction to this paper is that it is smart, it is honest, and it is subtly very critical. It's a strong paper, and I very much really appreciate the honesty of it. So let's go through my discussant comments. Will take 3 forms. One is on the econometric results, and here the identified reaction function, as David talked about, is kind of weak, with some unexpected things missing from what countries are doing and using their toolkit. And I'd say, yes, this is disappointing, but perhaps the results are not surprising. The second point that I'll come to is on the second part of their title, which is about a sensible reaction function. So it's a question, can this even be estimated? And I'm going to argue maybe with more time, maybe with more controls, but also maybe with more modeling that brings in other dimensions of the decision making. And then I'm going to agree very much with the authors that a holistic macroprudential reaction function is a work in progress, and the frameworks are currently in their adolescence. I think in addition to being in their adolescence, there's still work to be done on developing a full ex-ante policy cycle where institutions announce, give prior details on the conditions for activation and deactivation of tools. But I think there's also some other potential lessons from the work that time will help us identify too, which is maybe structural tools are easier to work on and perhaps more effective. And also maybe the use of tools is complicated by financial and regulatory structures, including the roles of non-bank financial institutions. So let's go to the next slide and we'll get into these 3 points. So on the countercyclical capital buffer, on the econometrics, it should be tightened when risks build up in the financial sector to reduce capital loss and credit crunches when the risks ultimately materialize. And borrower resilience tools should tighten to avoid unsustainable debt buildup. So the authors find really interesting mixed results using indicators that predict tool use. The countercyclical capital buffer and housing tools do tend to tighten after rapid non-financial credit growth, especially from housing. They tend to, but they don't always. And macroprudential housing tools are really interesting, not systematically related, tightened to house price developments or household debt service ratios. Let's go to the next slide. Okay, so why these relatively weak results? It could be that it was a long process in some countries before they activated the CCYB, and they clearly seem to have had different use preferences, and 40% of them did not even activate over the sample period studied, I think, in the paper. And the housing tool use was concentrated really in just a few active countries, and as David hinted at, might have been used for different purposes. So with this, both features should make it difficult to actually derive strong econometric results, which maybe explains part of what we're finding. Also, some countries used other tools instead, for example, stress testing, or mainly focused on enhancing the structural stability of banks or households. In all of these cases, the triggers for cyclical use of tools is not necessarily clear. There are possible concerns that about using tools when banks exhibit low profitability, and maybe there are political economy considerations that came into play in tool use. So next slide. My last slide on the econometrics. Then, the GDP at risk concept's super interesting in this context. Yes, it's the case that countries that activated the CCYB or housing tools had relatively higher GDP at risk, but it really was not a great predictor of tool use. And so one suggestion here is maybe to improve econometric specifications to account for potential tool effectiveness. And here I'd posit that domestic bank capital and banks may have a weaker relationship with growth and GDP at risk when there's a relatively low share of banks and credit provision relative to non-bank providers, and also when the household debt distribution is skewed towards lower risk households. So how do you take into account features of the financial and the household risk side when you're modeling these econometric relationships? Let's go to the next slide. This is a kind of interesting part. Now, the sensible reaction function, I have to say, so the authors find that so far, policymakers seem more willing to respond to household credit growth and equity market volatility compared to housing growth, corporate credit growth, and household debt service. So what I'd like to know from the authors is, can you find a sensible reaction function to explain this? So what would be the reason for that? Maybe there could be some modeling of the decision rules that account for the structures of credit provision across countries and over time, that captures something like the structure of regulation. It's fragmented perhaps across different regulators, or there's a limited span of reach of particular tools. So maybe there's different likely effectiveness of the instruments, for example, as would be the case if there was a large role of non-banks in credit provision and using the tools might just distort things. Or is it still just about framework adolescence? And does that include data gaps, short time frames, too few cycles, as you showed in the GDP at risk picture? So really too little time post-activation. Going to the next slide, I just have a little bit more. So let's just get to the last point on the holistic macroprudential frameworks. These are still a work in progress, although there has been tremendous progress so far. And you could see that by looking at online. The FSB surveys countries in their progress on building and implementing macroprudential frameworks. They have been establishing regulatory frameworks for oversight, enhancing system-wide monitoring and use of instruments. And the tools that are studied by the authors are exactly the tools I think where the most progress has been made. So they're, kind of right on track for seeing, how well have you done with the implementation? The challenge, of course, is assessing their effectiveness and calibrating the tools. As I mentioned earlier, there are unfinished frameworks for the ex-ante guidance on when to implement, how to use the level of tools, and when to deactivate these over the cycle. That would help with improving communications and also help with the issue of using tools for maybe industrial policy purposes or other goals that are not what you have set up as the macroprudential goals of these policies. So having those kind of frameworks and clarity, will help us see what we're testing on effectiveness and why decisions are made. So my last slide is just to conclude. This is just pulling up the last slide. So this is an honest and smart look at the facts. Some of the evidence might be easier to find with the passage of time and as the frameworks are better developed. I'd like to see kind of take on this challenge of if it's sensible, which would kind of bring in a whole range of other questions. And then I've raised a number of issues for econometrics and discussions. Are there other tools that are mitigating the user effects of these tools? Thinking about political economy, industry interests. If banks are already at higher levels of capital and maybe CCYB changes wouldn't be viewed as effective or needed, and how structural improvements maybe could be viewed as more effective tools rather than adjusting over the course of the cycle. So with that, I'll conclude. And I like the paper and really thought-provoking.
Thanks, Linda. That was a great, rich discussion, David, that you got. I don't see any comments in the chat. I'll just throw in, first of all, what I'm really excited about is sort of the open questions, all that's there to continue working on. And I'm very interested in political what you're not explaining so far, and whether the political economy can explain some of the cross-country differentiation in housing actions in particular, since there's just so much going on in Asia. But there's something else in Asia that, I'm in Hong Kong, and which is a currency board, and a lot of what the central bank does is in the realm of macroprudential policy, because they don't have monetary policy. And then so question arises, does monetary policy space the more general question that where you stand in monetary policy? How might that impact macroprudential reaction function? And with that, I'll give you the last 5 to 10 minutes or so of this great session we've had.
Thank you very much, Frank. And Linda, thank you especially for a really thought-provoking discussion. I must say, we did this work, we started it, it feels like only yesterday, but it's probably 18 months ago now, when it seemed, the question was really about building buffers. And it's kind of stalled a little bit just because all of my co-authors have been busy fighting pandemics and this sort of thing. So getting a positive reaction from you has kind of energized me to kind of return to this paper and actually finish it off. So that's already very, very useful. I think, the points you raise are really good ones. I think this, this question about trying to work harder to understand what is driving these tools. We have done a little bit of extra work around this, adding things like lagged levels of bank capital into our probit regressions to see if it's the case that countries have higher kind of endpoint capital ratios. Is that like a substitute for activating the CCYB? I thought that would be more successful than it was when I looked at that. So our evidence wasn't particularly strong in that area, but I will definitely come back to that. And I think these points about political economy are interesting, as you say, particularly for the housing tools. Yeah, so I'm not sure I have a great deal to add. I'll look carefully. If you can share your slides with me, I'll kind of look carefully at your points as we revise the paper. But this is it's been very useful just to get an independent cross-check on whether this is an exercise worth pursuing further. Maybe a last point I'd add is the place where we felt most nervous is about trying to benchmark policies against something to see, the sensible part of the question. And I think our ideas there are to kind of, maybe as we revise the paper, look at more types of metrics rather than just GDP at risk, but the broad early warning literature to see whether, what's the kind of sum total of variables emphasized there, and does that give you more of a way of rationalizing some of the actions we're seeing? But I suspect we'll still see a bit of a gap in terms of the way policies are being applied. I'll stop there. Thank you very much, and thanks everyone. Sorry to keep you up so late, particularly in Hong Kong and Singapore.
Bernie, you have any comments? We still got a minute left.
I turned on my just thinking about not really right now. It's already 1:30 our time, and I have at 8:30 tomorrow. Somehow I'm thinking about can we be a bit more ambitious to think about there's a lot of discussions about the integrated framework, the complementarity between the monetary policy and the macroprudential policy, and other related thing. So I wonder if there's some way to bring that thinking into your empirical work as well. But I don't know, it's too late for me to think about if there's any clever device. But when I listen to you, I'm thinking really a lot about the monetary policy, the macroprudential policy, and then people add to that the cash flow management policies and so on and so forth. So I wonder if we can be a bit more ambitious to capture the complementarity between the monetary policy and the macroprudential policy.
Yeah, I think that is a very good point. Particularly for maybe countries on fixed exchange rates where there's less ability to stabilize demand, and whether these tools are a complement in that case.
I mean, nowadays almost no country is independent. We're also connected, and so to bring them together would be really quite interesting empirically.
Yeah.
In the way you do it.
Thank you.
Maybe can I add one particular thought on the last comment? I think it's also important when you think about complementarity, who is actually activating the countercyclical capital buffer? Is it the regulator or not? Is it the central bank? Is that part of, is regulation part of the central bank? That can make a huge difference across countries.
And I think Linda's point about these industrial policies, I think behind all this, there's really a factor about the political economy, the institutional environment of the country. It's extremely important, and we cannot treat this devoid of the political economy, the institutional arrangements, and so on. And the reason that tonight we find it so interesting is that we cover India, we cover China, and so on and so forth. And all these countries have a different institutional background, and that brings the heterogeneity and the challenge to us all.
Great. So your paper is inspiring, David. Yeah, absolutely. So I think it's if someone has any other comment they'd like to make, that's fine. Otherwise, I'll bring this great session of papers to a close. I want to thank you all, presenters, discussants, people who were listening in, people who make comments. Otherwise, I can say from my perspective, it's been one of the most rewarding of the CEBRA joint events, because again, able to put together discussants and presenters from all over and get the best fits. I really felt it was hard to get a better discussion for each of these papers than we got. And I want to thank you all, both the presenters and discussants, and maybe see you next year. But in Singapore,
we also have to thank, yes, next year, Singapore, please. I hope that we are open, and I can treat you to a good meal and a good glass of wine and something like that. And let's take this opportunity also to thank Frank, and all the teams. They have done an excellent job. And Charlie, thank you. Until now, it's 1:34. You're still up with us. Thank you. And again, thanks to all the authors and the discussions. We really had well, you keep me up until 1:34, and I'm still energetic. So thank you. Thanks a lot to everyone.
Okay.
Thank you very much.
Thanks, everyone.
Thank you all.
Thank you.
Bye.
Bye.
Bye.